Hi, I'm Tom Stelzer from Livewire, and today I'm joined by Barry Miller from Ares to get his insights on private equity markets. Barry, thanks for joining us.
Thank you for having me.
Ares have written that private companies are the heart of the US economy, but what's the opportunity there for investors?
So if you look at the economy, you look at the market today, we continue to see pretty significant growth. And as we look at the opportunity, one thing that is interesting about the markets today is companies are staying private longer. And if you look at, the example I always like to give people, you look at the Wilshire 5000, it's not 5,000 companies.
Just following on from that, I think we've seen a lot of debate around the private to public discourse, and it seems there's a trend of a lot of companies staying private and a lot of the market moving that way. How do you see that developing over the next few years, and where are the opportunities there?
So I think there's actually an extension to that question. When it's not only just staying private, it's staying private for longer. So companies today are taking a little bit longer in that gestation period. And so when you look at it, it's an interesting tie, and we look at traditional private equity. One of the things about private equity is we've been living in this cycle of a 10-year fund. And as duration extends, as companies take longer to grow, this notion of how do you support them after that 10 years? And that's why we've seen this growth in the continuation vehicles, the GP-leds and so forth. But there is a real cost with being a public company. There are absolute real expenses. And if you think about a business that is in growth mode, this notion of being able to take money from those public company expenses and use it for research, development, and growth, there's a real value to that. And so I think as we look at the market in totality, companies will stay private longer. In many cases, they may stay private in perpetuity. But what's interesting about it is if you look at private equity just in general, this notion of private equity funds getting larger and more companies being sold to strategic buyers, there is a pool of capital that can support those. And I think it gives us a lot of additional runway as we look to the future. So as you look at it with this growth in private companies, the companies staying private longer, it's a continuing growing opportunity for investors.
And you mostly invest in private equity secondaries. What are the potential advantages to that strategy over, say, a traditional private equity fund?
So I think when you look at private equity secondaries today, one of the things that we always talk about is diversification. Diversification by sector, by stage, by vintage, by geography. And I think the second part that we try to focus on is what's called as J-curve mitigation. So if you look at the traditional private equity fund, could be a real estate fund, could be a credit fund, generally they have a life of 10 years. And so in that life of 10 years, it takes 5 years to invest, 5 years to harvest. We look at years 6 to 8. So after that investment period, so we can bring cash flow forward, enhance returns. And for many people, it mitigates that period of time when there's a little bit of that, you put that dollar in the fund and it's worth a little bit less.
And I think your fund is 3/4 of the portfolio is in the US, with, I think, tech, consumer discretionary, and financials accounting for about 60% of your sector weighed in. Why is that, and where are you seeing the opportunities there?
So as we build our secondary fund, again, going back to the previous question, this notion of diversification by sector, by stage, by vintage, by geography, we don't look to take industry risk, sector risk, timing, or geography. So from an index standpoint, we actually look to mirror the Russell in the US. And so when you look at the Russell in the US today, it has that weighting towards financial services, tech, as well as healthcare. Now, one thing that is interesting that we do is we underweight 2 sectors in the Russell. We generally underweight real estate and we underweight energy. And we do it for 2 very different reasons. For real estate, one thing that is interesting is it throws off some negative tax consequences for the structure we use. But more importantly, and I find this, when I talk to many investors, and whether they're high net worth family offices, is that many people have made their wealth in real estate. And they're looking to diversify their way out of that. So as a result, they're looking for something that's complementary, and they're not really looking for more real estate. And the reality is, if they haven't made their wealth in real estate, then they're probably looking more at a real estate focused product. And then for energy has been a challenge for secondary investors. And so as we look at that, it's been an underperformer. So we do purchase it. We will purchase it in certain cases of a larger diversified portfolio, but we will make sure that we price it for the appropriate risk.
And maybe just getting back to secondaries for a second there, we've seen huge growth in the transaction volume in secondary markets over the last decade or so. What do you think that's telling us about the market, and can you see that trend continuing into the future?
So I always like to answer the second question first. So as we look at the trend, the growth, we see significant growth in the secondary market. I think if you look at the transaction volume numbers just for this year alone, depending on who you talk to, I think the intention is that the numbers will be somewhere in that $200 to $225 billion number. But more importantly, if we look at the numbers through June of this year and through September, the June number was very similar to transaction volume 2 years ago. The number through September, which is about 170 billion, was as big, if not larger, than total transaction volume last year. So I think as you look at the secondary market, the real story is actually not over the past couple of years. What's interesting is if you go back and look over the last 15 years. Because when you look over the last 15 years, what you'll see is transaction volume has doubled almost every 5 years. So if you go back and project that out, we see a path to 400 to 500 billion. So that's a little bit longer way of saying we believe it's here to stay. And I think as you look at why this secondary market is growing, there's been a lack of liquidity in traditional primary funds. There's been a lack of liquidity for the last 2.5 years. And as you look at the definition of being a secondary manager, we are a solutions-based provider. And so what does that mean? We offer liquidity to investors. And as the market continues to grow, we grow the market. So we're excited about the secular tailwinds for both.
Maybe just move into your fund for a second. I think the Ares private market strategy has exposure to more than 7,500 companies in the US. But do you mind explaining maybe a bit behind the selection process there?
So what's interesting about secondaries is diversification is paramount. And so as we think about building out the portfolio, we are less concerned about fund concentration. We are less concerned about sponsor or manager concentration, but we are laser focused on company concentration. So as we look at company concentration, we generally try to size companies no more than approximately 3% of the fund. Now, the fund is continuing to grow, so that 3% is a little bit of a moving target from an absolute dollar figure. And as we look through it, while the fund is in 7,500 plus companies, there's a significant portion of those companies that are very, very small. So you have positions that are $100, $1,000, $5,000. But when you look at the top 10 holdings, the top 10 positions in the fund, that represent probably 40 to 50% of the existing net asset value, it continues to be diversified. And I would imagine as the fund continues to grow, while the number of companies will grow, that diversification, that 2.5% to 3% number, will remain consistent.
Do you maybe have an example of or talk us through the life cycle of a previous investment you've made that maybe brings the portfolio to life?
So we do two things in the fund, effectively, when you think about secondaries. So the fund is anchored in secondaries. We do traditional LP investing, so we are a replacement investor. And we also do GP-leds, where it's a company or a group of companies that need a combination of more time and or more money. So I think as you look at it, the diversified portfolio of LP stakes is probably the best place to start. I think for a lot of investors, that's what they think about, or that's what they know about secondaries. And so if I look at some recent transactions that we've done, we have been able to be that liquidity provider. So we did a transaction, it won Deal of the Year in April of last year, where we bought a $1 billion+ diversified portfolio, 6 to 8 years old. Manager was looking to effectively generate some DPI for their investors. So dollars paid in, money back to the investors. Going back to some of our earlier conversation, this lack of liquidity that's been coming off funds, sponsors today need to figure out how to return money. So what we did was we purchased a vertical strip, so a vertical strip of the entire portfolio. We were able to generate that liquidity for the investor. This is a portfolio, it's actually the largest holding in the private markets fund. Today it is over 3,500 companies. It's over 1,000 LP stakes and over 400 managers. So this is a highly diversified portfolio. Today it represents about 14.5% of the entire fund. And so when you look at it, it's a great example of one being a solutions-based provider. Our counterparty was looking to generate distribution. We were able to be a total solutions-based provider for that. Building diversification. It is, as you think about secondaries, this is that classic secondaries portfolio. Diversified sector, stage, vintage, geography, 6 to 8 years old, deep in the harvest phase, 70% funded. And based on our underwriting and where it has performed, it's generated significantly more cash flow than our base case returns.
Maybe just moving to returns for a second. How do you go about, I suppose, targeting your range of returns? Where are you looking for those returns in the markets?
So when we launched this fund back in April of 2022, we looked at our targeted rate of return, and it's model driven. Everything we do is model driven. So we looked at our base case returns for LP portfolios. We looked at our base case returns for GP led, and to get our targeted rate of return, which is a mid-teens return, we came up with a blend of what the optimal portfolio would look like, which is why when we look at it today, we are currently 95% secondaries. We are predominantly focused on the LP side. The LP side gives us that high velocity cash flow, that money coming back quicker, because one of the benefits of the structure that we have, these perpetual products, is compounding. And so we are less focused on multiple invested capital, we're more focused on internal rate of return. But because of the perpetual nature, that multiple invested capital comes naturally as long as we have deal flow. And deal flow has been incredibly robust, going back to the earlier question on what does the market look like at $225 billion of overall transaction volume. We're doing 1.5 to 2.5% of entire transaction volume. Said differently, we're saying no 98.5% of the time. So I think as you look at it today, targeting that mid-teens return, bottoms up model, and we feel quite good about where we are.
And finally, there's been some concerns over secondaries, I think especially around front-loaded returns, talking about returns there. What do you think investors need to be aware of there?
So I think when you look at any investment, whether it's private equity, public equity, mutual fund, it doesn't really matter what it is. One thing I think that is paramount is the quality of the manager. And so if you look at the quality of the manager, Ares Management, we've been doing secondaries for over 30 plus years, one of the pioneers in the space. If you look at Ares Management as a firm, 25 plus year track record. If you look at us as a growth opportunity, today the company has had significant growth just from an AUM standpoint as well as performance. And as someone said to me, when I started in this business 25 plus years ago, we only do two things. We raise money, we invest money. For a good investor, we should raise more. For not a good investor, you shouldn't give us your money. So I think as the performance that we've been able to deliver, not only in our semi-liquid product, but as well as our drawdown funds has been incredibly consistent. So as an investor, look at strength, quality of the manager, depth and breadth of the team, actual performance, because I think that question comes as what do I need to believe? It's one of the things we ask in our investment committee when we look at transactions. So if you look at something similar to the private market strategy, you don't have to believe much. We launched the strategy in April of 2022. The returns have been incredibly consistent. Again, they're all out there in the public domain. And so I think those are the things to look at.
Barry, thanks for joining us.
Excellent. Thank you for having me. I appreciate it.
Thanks for tuning in. For more great videos, make sure to check out our YouTube channel.